Brian Armstrong was born on January 25, 1983, and from the beginning his life followed a quiet but unmistakable arc towards systems, code, and problem-solving. Raised near San Jose by engineer parents, Armstrong grew up in the shadow of Silicon Valley before it became a global symbol of wealth and disruption. Unlike many future tech founders, he wasn't chasing fame or cultural relevance early on. He was interested in how things worked, how systems scaled, and why certain inefficiencies were tolerated simply because that's how it's always been done. He attended Bellarmine College Preparatory, then went on to Rice University in Houston, where he double majored in economics and computer science. That combination would later prove crucial. Economics taught him how money, incentives, and markets behave. Computer science taught him how systems could be redesigned from scratch. While still a student, Armstrong founded an online tutoring marketplace called universitytutor.com. It wasn't flashy, but it was practical, profitable, and revealing. Armstrong was drawn to businesses that removed friction and connected people more efficiently. After graduating, Armstrong spent time abroad in Buenos Aires working on education technology. It was there, in Argentina, that his understanding of money began to change. Inflation, currency controls, and limited access to global financial systems weren't abstract concepts, they were lived realities. When he returned to the United States and began working at companies like Deloitte, IBM, and eventually Airbnb, he carried those observations with him. At Airbnb, Armstrong encountered a problem that would quietly reshape his future. The company operated across dozens of countries, and moving money between them was slow, expensive, and riddled with intermediaries. Cross-border payments, something the internet itself had supposedly made obsolete, were still governed by systems designed decades earlier. Armstrong began to see money not as a fixed institution, but as a piece of infrastructure that hadn't been meaningfully updated. Around 2010, Armstrong encountered Bitcoin for the first time. At first, it was simply interesting, an academic curiosity, a cryptographic experiment, but the more he studied it, the more it clicked. Bitcoin wasn't just digital money, it was a global payment network that didn't require permission. No banks, no borders, no clearing delays. For Armstrong, this wasn't about speculation or rebellion, it was about architecture. He began buying Bitcoin and experimenting with storage and transfers, and quickly ran into a glaring issue. For average people, crypto was confusing, risky, and inaccessible. Private keys could be lost, exchanges were unreliable, security was inconsistent. If crypto were ever going to reach mainstream users, someone would have to build a trusted bridge. In 2012, Armstrong posted on Hacker News looking for a co-founder to apply to Y Combinator. One response came from Fred Ehrsam, a former Goldman Sachs trader with experience in foreign exchange. The pairing was almost perfect. Armstrong brought engineering discipline and product thinking, while Ehrsam brought market experience and financial intuition. Together, they founded Coinbase in San Francisco. The mission was deceptively simple: make it easy and safe for anyone to buy and sell Bitcoin. At a time when crypto exchanges were opaque, lightly regulated, and frequently hacked, Coinbase took the opposite approach. Armstrong pushed for compliance, security, and transparency from the start, decisions that were unpopular with crypto purists but essential for mass adoption. Coinbase grew steadily, not explosively. It expanded from a basic Bitcoin wallet into a full-scale platform offering trading, custody, and infrastructure for both individuals and institutions. As new cryptocurrencies emerged, Coinbase became a gatekeeper, deciding which assets met its standards for security and legality. That role drew criticism, but it also built trust with users who wanted exposure without chaos. By the mid-2010s, Coinbase was the dominant U.S. crypto exchange. Armstrong had positioned the company as the safe option in an industry known for volatility. Institutional investors, hedge funds, and corporations began using Coinbase for custody and trading. What began as a consumer app quietly became a pillar of the crypto economy. In April 2021, Coinbase made history by going public through a direct listing on the Nasdaq under the ticker COIN. It was a landmark moment for the industry. Crypto was no longer fringe. It was now represented by a publicly traded American company with audited financials and quarterly earnings calls. Overnight, Armstrong became a billionaire on paper, and Coinbase's stock price became a proxy for the health of the entire crypto market. With that visibility came pressure. Every decision Armstrong made was now scrutinized by investors, regulators, employees, and the public. Coinbase's revenue rose and fell with crypto prices, exposing the company to brutal market cycles. During bull markets, Armstrong was celebrated as a visionary. During downturns, he was criticized for layoffs, losses, and strategic bets. Armstrong's leadership style became a topic of conversation in its own right. In 2020, he issued a controversial internal memo stating that Coinbase would remain focused on its mission and avoid political activism at work. Employees who disagreed were offered severance packages to leave. The move sparked widespread debate across Silicon Valley. Supporters praised the clarity and mission focus. Critics argued it ignored the social responsibilities of powerful tech companies. Armstrong, characteristically, framed it as a question of organizational efficiency rather than ideology. As crypto grew, regulators took notice. Questions mounted around whether certain tokens were securities, how staking programs should be regulated, and whether exchanges like Coinbase were operating outside existing laws. Armstrong repeatedly called for clear rules, arguing that innovation could not thrive in regulatory ambiguity. In 2023, that ambiguity boiled over. The U.S. Securities and Exchange Commission filed an enforcement action against Coinbase, alleging it operated as an unregistered exchange and that several products violated securities laws. The lawsuit was part of a broader crackdown on crypto firms. For Armstrong, it was a defining moment. Coinbase fought the case aggressively, arguing that the rules themselves were unclear and that the SEC was regulating by enforcement rather than policy. The legal battle dragged on as courts and lawmakers wrestled with how decades-old financial laws applied to decentralized networks. Eventually, the tone shifted. Courts pressed regulators to better justify their positions, and political momentum began favoring clearer frameworks. By early 2025, the SEC moved to dismiss its case against Coinbase, signaling a major turning point. The war wasn't over, but the ground had shifted. Throughout these battles, Armstrong remained a vocal advocate for crypto's long-term potential. He spoke openly about a future with hundreds of millions, even a billion, crypto users. Not as traders, but as participants in a new financial layer for the internet. Coinbase expanded globally, invested in developer tools, and continued building institutional services that mirrored traditional finance while operating on new rails. Armstrong also explored philanthropy through crypto. He launched GiveCrypto.org, aiming to use digital assets to deliver direct aid to people in need. Over time, the initiative was wound down after concluding that other models were more effective at scale. The decision reflected Armstrong's broader pattern: experiment, measure, and adjust when reality diverges from theory. Personally, Armstrong remained relatively private. Unlike some crypto founders, he avoided extravagance and spectacle. His wealth, largely tied to Coinbase stock, fluctuated dramatically with markets. Some years placed him among the richest figures in crypto, others saw sharp paper losses. But his focus remained on infrastructure rather than hype. Critics continue to debate Armstrong's legacy. Some argue Coinbase represents centralization within a movement meant to eliminate middlemen. Others say without companies like Coinbase, crypto would never have escaped its niche. Armstrong's defenders emphasize that adoption requires trust, compliance, and usability, and that idealism without infrastructure doesn't scale. What's clear is that Brian Armstrong helped build one of the most important gateways between traditional finance and the crypto economy. He didn't invent Bitcoin. He didn't promise overnight revolution. Instead, he built plumbing, custody, exchanges, compliance, the unglamorous systems that allow new ideas to function in the real world. As crypto matures, Armstrong's influence will be measured less by price charts and more by durability. Whether Coinbase becomes the backbone of a global financial layer or simply a transitional bridge, Armstrong's role in shaping the industry is already cemented. His story is not about rebellion, memes, or sudden riches. It's about systems, about seeing a broken process, believing it could be redesigned, and committing over a decade to making that redesign real. Even when the rules were unclear, the critics were loud, and the outcome was far from guaranteed.